Hello everyone and welcome to today's webinar, LBMA's 2023 Precious Metals Forecast Survey, Behind the Analysis. Today's webinar will be led by Cameron Alexander, General Manager Commercial Development at Perth Mint, and who will be joined on the panel by Marcus Garvey, Head of Commodities Strategy at Macquarie Group, Thorsten Polleit, Chief Economist at Degussa Goldhandel GmbH, Nicky Shiels, Head of Metals Strategy, MKS PAMP, and James Still, Chief Precious Metals Analyst at HSBC. Now, before we begin, if you have any questions during the webinar, you can submit these using the Q&A button that you should be able to find at the bottom or the side of your screen. So now, without further ado, I will hand over to Cameron. Over to you.
Thanks, Tamsin. And hi, everyone, and thanks for joining the call today, wherever you are in the world. I'm in Perth, Western Australia. Thanks to the LBMA and to our panelists for willing to be in the hot seat today and for making themselves available. This year already has seen some significant swings in the precious metal prices, with the gold prices kicking off the year with a strong rally of over $120 before seeing a sizable pullback more recently in February. Having weakened towards the end of last year, the dollar clawed back some ground in February as stronger than expected US data releases since the start of the month have reinforced that Fed's message about stronger for longer interest rates. Geopolitical tensions continued to play out. There's now been over a year since the Ukraine-Russia conflict first started. 30 analysts took part this year in the annual LBMA price forecast survey, and the outlook for gold and silver among this cohort remained cautiously optimistic for 2023, forecasting them on average to be 3.3 and 8.8% higher, respectively, by the end of the calendar year. Palladium sees the most negative sentiment for price, with analysts expecting a fall of 14.3% compared to 2022 prices. But analysts have shown a bullish view to the performance of platinum, with an increase of 12.5% forecast against last year's prices. Now, analysts were asked to name three drivers for the gold prices this year, with the US dollar and Fed monetary policy perhaps not surprisingly chosen as the largest single driver, with inflation and geopolitical factors also having a significant impact. Following an average gold price in 2022 of a tad over $1,800 an ounce, we have an average price amongst our 30 analysts of just shy of $1,860 for this year, the range of $1,594 to 2025. For silver, the average forecast price for the year was moderately higher, 8.8%, at $23.65 an ounce, up from $21.73 recorded in 2022. Again, quite a spread, with a forecast range from $17.50 at the low end to a high of $27 an ounce. Just a reminder to keep your questions coming during the presentation. I will try to sprinkle them in during the discussion, or we can pick them up at the end in the Q&A session. And at this point, I'd like to bring in our first of our panelists to break down their forecasts and to explain their thinking behind these forecasts. And first up is Thorsten Polleit, Chief Economist at Degussa Goldhandel GmbH. Thorsten, you are forecasting further upside in gold and silver this year, with an average price of $2,000 and $26 respectively. Firstly, welcome, and can you explain your thinking behind this bullish outlook?
Thank you very much, Cameron. Let me start by saying thank you for inviting me. It's a great pleasure for me to be on today's panel. So let's dive right in. There are a number of factors that I believe will be quite supportive of the price of gold this year and in the years to come, irrespective of some recent headwinds. Gold demand in China and India, which together accounts for nearly 50% of global gold demand, is likely to rebound this year after showing considerable weakness over the past 2 years, which should have a positive effect for the price of gold. In 2022, central banks bought 1,136 tons of gold. I expect non-Western central banks in particular to remain heavy buyers of gold going forward, as they look to further diversify their FX reserves and reduce their exposure to the US dollar and other Western currencies. So the key word in this context is de-dollarization. While I do not believe the greenback will lose its global reserve status overnight, I do anticipate that more and more private and institutional investors will tend to swap part of their US dollar holdings for other assets, including the yellow metal. And this should also help push the market valuation of gold higher. As far as the supply side is concerned, I expect subdued new mining output. High inflation increases miners' production costs considerably. Think of energy, mining supplies, and wages, which unfortunately for mining firms or many mining firms are not fully offset by higher gold prices. This aspect is particularly important given the continued decline in the grade of gold in many mines. That said, I expect global gold mining output growth this year and next year to remain below its long-term trend, which I estimate around 1.7% per annum, which should also be positive for the price of gold. The central bank's interest rate hiking frenzy is certainly negative for gold, no doubt about that. Higher interest rates increase the opportunity costs of holding gold, lowering demand and hence the price. I don't want to talk too much about macroeconomics at this juncture, but I want you to know that I believe central banks will overdo it, raising interest rates too much and damaging the economic cycle and financial markets to such an extent that their monetary policy tightening will need to end and be reversed later this year. This should also prove a boost to the price of gold. Combining this and with my assumption that the current price of gold is already on the cheap side, I forecast, as you said, Cameron, an average gold price of $2,000 per ounce this year, with an upside potential of up to $2,200 per ounce. And let me end with some remarks on the price of silver. The expectation of a substantially higher gold price going forward is a good reason that silver price to edge higher by quite a margin. As you already pointed out, my average price forecast for silver is $26 per ounce for this year, with an upside potential of up to $29 per ounce. As far as silver demand is concerned, the move towards renewable energy and non-carbon emitting energy has a good chance to translate into a higher demand for physical silver. Also, an upward moving silver price is also likely to attract new investments via exchange-traded products, adding to overall silver demand. The supply of newly mined silver, which has been basically stagnating since 2012, is likely to remain subdued. Higher production costs due to elevated inflation and thus downward pressure on miners' profitability make a decline in capex likely this year and next year, which can be expected to keep the silver market relatively tight, translating into higher prices. Well, I stop talking now, as I may have overextended my speaking time already. Thank you very much for your attention. I'm looking forward to the views of all the other panelists and all the questions our audience may have. Thank you.
Thanks, Thorsten. And we'll come back to some of your comments a bit later on, as there's quite a bit to unpack there. But next, I want to bring in Nicky Shiels, Head of Metal Strategy at MKS PAMP. Nicky, in your forecast with an average of 1880 for gold, you highlight rising stagflation and recession risks, driving US dollar strength and peak US yields. You also point to higher physical demand for this year to provide sort of a foundation for the price. Can you talk us through sort of that influence and the impact the macro environment may have on gold and silver?
Yeah, thank you. And thanks for having me on this panel. So I think, if we take a step back, we're looking at 2022 pricing for gold. And I think in a nutshell, it was pretty frustrating. We had war and we had inflation, two massively bullish drivers emerged last year, and gold basically finished the year unchanged. So yes, it certainly was a bit of a frustrating year for gold bulls. But our thinking is that a lot of the bullish drivers last year are still very evident this year in 2023. And again, going back to physical support, we see Thorsten already talked about central bank gold buying being at record highs last year. We continue to see that de-dollarization theme playing out. this year, especially the more and more sort of deglobalization kind of accelerates. We see very, very strong physical demand, both on the coin and bar side. We had record higher, a record year last year. We see it being pretty good, not as great as last year, but still a very big supportive influence for gold and silver, especially at lower pricing. And I think the kicker for this year is just the marginal player is certainly investment demand, and that wasn't, there were massively sort of net outflows last year contributed to headwinds in the gold and US dollar pricing. But this year we certainly do see investment demand re-emerging, certainly with the view that the US dollar has peaked. We had a massive move in the US dollar last year. Monetary policy acts with the lag, and so whether we get a recession at the end of this year, that quite isn't the narrative at the moment. But monetary policy, the hikes that we saw last year will come back to market, and we do believe that the Fed will ultimately break something before gold can go lower.
Okay, and you talked about the strong physical demand that we saw particularly last year and earlier this year. Do you think that can just be sustained throughout 2023? Or what would be the headwinds to sort of push that backwards?
The headwinds to see reversal in physical flows. The one headwind would be a weaker dollar, but at the moment we're seeing, if you look at gold in cross-currency terms and the performance it put in last year, gold in most cross-currency asset classes really outperformed both FX and local indices, and we're seeing that carrying through this year as well. You see it in regional premiums, you see it in central bank demand stats, you see it in trade stats. So we don't think physical demand will be as strong as last year, but it's still good. It's not great, but it's still very decent.
Okay, and we talked about sort of central bank activity last year in near record levels. Perhaps this is one for Thorsten as well. I mean, do we expect to see anywhere near those kind of levels this year, or are we sort of well off the peak from last year?
I think we'll continue to see central bank de-dollarization, especially from non-Western central banks, as they implement these sort of de-dollarization schemes. Again, central bank demand is not going to chase. They're not going to chase gold at higher pricing, but certainly I think at 1,1800 becomes more of a net tailwind for pricing at lower pricing.
Thanks for that. I do have a question that's come in already. I'll just put that one to both of you while we're dealing with the gold and silver. And that is, what is the impact of the Turkish earthquake on the Turkish central bank buying? So will they reduce the pace, or on the contrary, will they be buying more gold, in your view?
I think so the way I think about it is, at the moment, it's any kind of emergency or crisis, there really shouldn't be an immediate demand for gold. The focus is, like we saw in COVID, it's securing medical supplies, it's shoring up cash. I don't think the focus is restocking gold at the moment. But then again, I think you take the view is to look at it through a currency lens, and certainly the weaker the lira has become over the year, there's a very, very strong correlation with both central bank demand and both Turkish retail physical demand. So if the view is that the earthquake ultimately will have a negative effect on the economy and the lira will weaken further, I do see in the sort of more medium to long term that both physical and central bank demand will probably rebound.
Great. And if you just quickly turn to China, we've seen some significant weakness over the last year or two with a very, very soft housing market. Are you expecting to see a sort of a China consumer bounce back this year that will generate sort of higher demand for precious metals?
We do believe China will be a net tailwind in 2023 for all metals versus 2022. Again, the reopening theme has been a little slow at the moment. And I think data coming out of the next couple of weeks will be very instructive. But on a sort of aggregate basis, we do see them being a mild tailwind for all commodities or precious metals going forward into 2023.
Terrific. Thanks for that. Any other comments you want to make before I move on?
No, that's all from my side.
Terrific. Okay, we'll leave gold and silver there for the minute and move over to PGMs. And just a reminder, if you do have any questions relating to those metals, please put them into the question box and I will try to deal with them today. I'll start with the bullish outlook and bring in James Steele, Chief Precious Metals Analyst at HSBC. Jim, you were quite bullish for both platinum and palladium for the year. You have platinum averaging 1241 an ounce in 2023, and with the market swinging into deficit. You also highlight a strong auto sector and jewellery demand and a more robust investment sector, and aided by a potential for supply disruption. You're also supportive of high prices for palladium with an average of 2180 for this year. So can you walk us through your outlook on both of these metals and what your view will be to be the key drivers for price action?
Yes, indeed. And again, thank you for the privilege of addressing everybody, and thanks to the LBMA for all their hard work. We are looking for recovery in the palladium price. Admittedly, we've seen some quite pronounced declines, but if you look at the bedrock of the fundamentals, I think it still paints a moderately bullish argument going forward. We're looking for less of a deficit, but still a deficit for this year, as well as a good auto demand. Now, just a question, or just an issue on the auto demand, because it certainly spills over into the platinum. We're likely to see greater auto production this year, that's for sure. But we're also going to have greater electric vehicle production, and we're also going to have greater substitution from palladium, from higher priced palladium towards platinum. And this is going to make quite an impact on what would otherwise have been, I think, a significantly higher palladium auto demand. Now, we're still looking for this demand to be higher, but it's not going to be as high as it would have otherwise. When I say higher, I mean, we're still going to get a gain on last year, given the gross number of autos that are going to be produced. And most of them are still going to be gasoline vehicles. Now, some of this is going to be offset by an increase in recycling, as a lot of older vehicles have been held onto, and they're going to go up into the scrapyard, and that's going to increase some of the supply. But nonetheless, I think that it's important that although EVs are going to continue to cut into the market, and substitution is taking a chunk out of palladium demand, that the peak EV inroads are not going to be made for another couple of years yet. And it strikes me that that story has been brought forward a little too aggressively, and it has done a lot of damage to the palladium market. Now, the market can be very volatile. It's only, both platinum and palladium are only around 6% the size of the gold market, so we can get these enormous swings. There's not much of an investment demand for the palladium, admittedly, but on the supply side, I think we're still going to see uncertainty. Although we are looking for greater production out of South Africa and surprisingly good production out of Russia, a couple of things can always shave this. The Eskom issue in South Africa and many other things too, the amount of power, that will also impact platinum, obviously. Now, when it comes to Russia, we did react very violently last year to the possibility of a lack of production coming, or not getting to Western markets in the invasion of Ukraine. Well, I'm not certainly saying that there's going to be supply disruption, and I don't mean to give that impression, but the uncertainty remains there. We don't know what's going to happen. PGMs have gotten out of Russia. They have gone to other markets and maybe ended up in the West. That's well known, but we still don't know what's going to happen, and the uncertainty there can affect particularly the palladium. So we are still looking for a deficit of this year, although we do imagine that the market will swing into a healthier surplus next year. And really, it's next year and the following years that we're looking for the big declines in palladium. This year, we think, might be the last year of a significant deficit and decently higher prices. Now, a lot of what I've said also pertains to the platinum. But I would make the point that the demand is going to be boosted by substitution. It's 1-for-1 basically with the palladium. And this is going to be the key factor, I think, in the platinum market going forward. But platinum is more reliant on South African production than it is on Russian. And here too is where we're going to have to be aware that there's going to be less than would otherwise have been the case because of Eskom, because of and I don't mean to blame Eskom for everything, but just the situation of power outages in general, other technical difficulties faced in South Africa is just going to keep these markets clipped as far as production goes. And production is going to be below what it was earlier in the decade. That's the important thing. Although it might be up this year, there's still, from last year, it's still going to be lower than it was historically. The other thing too is that we're still looking at good gains in the environmental realm for platinum. And the uncertainties on platinum are much more price positive, I think, in this regard. In addition, we could see, as was discussed earlier in China, better jewelry demand. We've had a long-running spate of very poor platinum jewelry demand in China for various different reasons. We know it's the favorite wedding ring, and the decline in the number of marriages has had an issue. Also, it's been reduced as a sort of luxury good. But we think all of this is sort of bottomed out. And it wouldn't take much to get a couple of 100,000 ounces more in the platinum market. And for that reason, as well as good investment, I mean, we're seeing that already in the gold. And it wouldn't surprise me if we get a sort of knock-on effect on the platinum. And that's going to, in our view, shift us from a moderately high surplus last year into a much more pronounced deficit this year, followed by an even greater one next year. And I don't want to take up all the time. Maybe I've gone too far now, so I'm going to stop.
That's fine. Jim, do you have a view on Japanese platinum jewelry demand going forward?
Well, it would strike me too that any further weakening in the dollar, as well as bar demand, actually, I think is where we might see, particularly as well as jewelry, more bar demand in the Japanese market as well, if we can get further dollar weakness, which I believe HSBC. I don't know what we're saying about dollar yen particularly, but overall we're slightly negative on the dollar still.
Okay, great. That's terrific. Okay, our final panelist today is Marcus Garvey, head of Commodities Strategy at Macquarie Group. And Marcus, you are not as bullish as Jim for both metals, but you do see some healthy gains, some healthy upside there. You have platinum averaging $988 this year, with palladium at close to $2,000 an ounce, potentially driven higher by stronger auto sales and ongoing uncertainty around Russian sales volumes. Now, you highlight potential structural challenges of rising EV penetration, scrap supply growth, and primary supply expansions. Marcus, talk us through your outlook and give us a bit of colour, if you will, what in your view will shape the PGM market this year.
Sure, thanks very much, Cam, and also to the other panelists and to the LBMA for hosting us. So I think on the palladium side, I don't significantly disagree with Jim at all, thankfully, which is a much safer place to be than if I was taking a strongly opposing view. But when we look at it on a sort of 3 or 5 year view, exactly those points around EV penetration, and I agree with Jim on this, for us, that really starts to tilt the market because you hit sufficient EV market share and tilt the market against palladium in probably the latter part of next year or more like 2025 on our balances. But this year, we do still have a deficit for palladium. And actually, we had, I think, 1,600 as our low point for the year, and clearly the price has already underperformed that. And I think when we look at what's happening in the nearer dates for palladium, there is a somewhat fundamental element to that, in my view, in the way that, for example, Chinese auto sales started the year quite weakly. You can explain that a bit with an early Chinese New Year. You can also say, well, actually the purchase tax cut that you had last year was not rolled over. That might come back and give you some improvement later the year to sort of look through it a bit. But at the very short term, in the front end of the physical market has not been particularly tight. And actually, I think one of the challenges you have about finding people to sort of buy that dip is because you don't have a structural narrative, and also because you don't have particularly good liquidity credentials for palladium against the rest of the complex or many other commodities. You're not seeing investors really step into this in the way that they might have done in the palladium market if it had a big move down, 5 years ago, for example. And actually, I think that does mean that palladium is getting to the point, in our view, where in short term it's actually considerably oversold. And I think if you look at the way that the market has been driven somewhat by this reversal in the dollar, but we're really within that on a specific palladium flow basis by a relatively small absolute short, but in proportion to the current scale of the palladium market, both in terms of the volumes that trade or the open interest, it is, I think, sort of the tail wagging the dog and a financial market which has oversold palladium. But what is the catalyst to see it sort of supported and driven back up? If we're right that you do have a sequential improvement in year-on-year terms this for a full year in autos, and that it can be somewhat counter-cyclical to other parts of the global economy being weak because you're seeing fewer supply chain issues, then you should see the physical market step in and take on the available ounces here and tighten the market up. But that takes some time. At the moment, certainly while China has started the year weak, and so actually it's something where there isn't an immediate reason for the market to turn. You just need to find some sort of catalyst, which I think if you do get it, for example, enough forward consumer hedging, you could have a very violent rebound in palladium because you would have short covering that really then catalyzed that a move up, becoming far more aggressive than if you're at levels that seemed sort of fundamentally consistent in the very short term. But as I say, I think for us, this is very much to Jim's point, actually, the last year of a kind of substantial or potential for a substantial deficit in the palladium market. I think to have one further out, you would need to either find that EV penetration, which at the moment, when we look at it, seems to be progressing reasonably along sort of S-curve path to something sort of 40 or even a bit higher than 40% global penetration by the sort of early 2030s, then if you don't step off that, palladium does have a big structural headwind. And so to get into a palladium market that was tighter for longer, you'd neither need to see kind of reversal of substitution, or I think more likely just bigger issues on the supply side. But that's something you'd be kind of holding out hope for if you're a palladium bull, rather than something that I think you can automatically forecast as a base case, even when we look at these challenges that the supply has both in Russia and in South Africa. From a platinum perspective, I think conversely, there is clearly a much more positive structural narrative in terms of the substitution that's coming its way. And then when we look further out, I think there is a period where it's going to face a challenge when EV penetration is rising faster than you're seeing hydrogen economy, and really within that fuel cell vehicles, because electrolyzers are not, in our view, going to be a big driver of the market. We don't think the scale is big enough given how low their loadings are. But you're probably not going to see fuel cell vehicles step in sufficient size to the market in, say, the middle back end of this decade to have a big impact. I think that's more a later this decade and probably 2030s story. And so that when we look at the market kind of this year, next year, you do still have a small surplus, probably in our numbers in the order of kind of 200,000 ounces, and then a market that tightens up a little bit because of these supply challenges and because of substitution, but you don't really go into sustaining deficits. So that I think what we find with platinum is that although physically the balance looks kind of okay, you don't really have enough to get you a big investor narrative, and you don't have enough physical tightness to really boost prices independent of what the investment part of the market is doing. What I think you've had in terms of this year's price action is a bit of a run up, partly on a hydrogen narrative, as some people are thinking longer term, but more so I think on concerns about South African outages and really the back end of last year, and similar to gold, that tail end of that dollar weakness. And then we've just seen an investor reversal drive us back down. I think what would support the price, and we're looking out for quite closely here, as it did multiple occasions last year into dips, is do you see a big pickup in Chinese buying? With the early sign of that generally being something like the SGE volumes for the platinum contract moving higher into a dip, because I think that's one of the things that's clearly made platinum trade tighter than the paper balance would suggest, is the fact that Chinese apparent demand has been higher than most people's estimates of real demand are. I mean, certainly than ours. So that as we come down in the platinum price, I think that's a more natural thing to come in and support the market, even though you don't actually have a deficit in our numbers on paper. You can see the market start to behave like it has one if you see Chinese buying come in and support the lows as we get down towards sort of 900 or even a bit below that if you get some further dollar strength. But on the top side, unless you have really much bigger supply issues or we are sort of really undercooking it on our views on things like substitution, I think it's hard to see the market get really tight as yet. I think that's still something that's possible down the road, but is not something that we see happening in the immediate future.
No, thanks for that. That's good. I've just had a couple of questions that have come in on the line. I've just one of them. You sort of both spoke to this just in the last few minutes, but I'll just put it to you. What percentage of platinum supply will be lost due to power shortages? I mean, I guess we're looking for a breakdown there. And can companies buy generators to offset this? And will that increase? What increase will there be to the cost of production? And will it be a material amount?
I think it's very difficult to say. Oops, yeah, I think it's very difficult to say how much will be clipped. We're still looking for South African production to be up this year, but only about 130,000 ounces, and it would have been up well over 200,000 ounces, I think, without the not just the power shortage issue, but other challenges that are faced. And to my knowledge, still, despite the higher costs of doing business, it is still profitable to produce PGM so in South Africa. So I don't see there being a reduction because of that.
No, fair enough. We've also seen.
Do you have anything on that?
Sorry, Marcus.
I'll just ask Marcus if he had anything to add on that.
I was just going to say, I mean, I think in my mind, you may get the risk this year that it becomes a slightly more acute issue because, as Jim mentioned earlier, Eskom's had significant problems. I think that's well known in the market. But the way that we're treating it to a great degree is it's a kind of chronic problem. Is that this is just going to be something that continues to drag at the margin on what production is, rather than giving you a sudden crunch. Of course, there is the risk of something that causes a sudden crunch, but it is something that the South African producers have dealt with, albeit not necessarily on the scale they're currently having to, but on significant scale for multiple years, and have been pretty impressive actually in terms of how they've managed their production to deal with it. So it's something that we will see as a kind of general drag, rather than something that gives you a big sudden loss in the way that something like a mine flood could, for example, or some other incident that would cause someone to have to declare FM, for example.
No, thanks for that. We have seen the West particularly started to target sort of Russian metals and mining sector directly by raising tariffs on more recently aluminium, but other commodities as well, including precious metals. What impact would these actions have on the precious metal markets, if any, this year?
I guess I'll take that. I mean, I think I look at it as just it sort of supports the structural higher inflation regime for longer, because in any sort of tariffs, whether it's directly on commodities, certainly is inflationary. And again, whether that is bullish or bearish for precious metals, it's how precious are trading. If we're going to get higher structural inflation for longer, and that means a more aggressive Fed, then precious metals could potentially, in the short-term trade, obviously pretty defensively, which has been the case throughout February. So anything that supports the higher for longer Fed regime equals kind of lower for longer precious. But if we start to see investors re-engage in the precious market as a asset class to combat high inflation, you sort of get inflation-driven demand on the investor side, then I think you can start to see more of a structural move higher in precious due to sort of policy making, let's call it just Western policy making targeting the commodity sector, which ultimately is a high inflation regime.
Now you're talking inflation, and we get the question all the time, is gold still an inflation hedge? I could put it to all of you. What's your response to that? And is it still sort of a primary inflationary hedge, or is it now just another option?
I think it depends on.
Please go ahead.
Go ahead, Thorsten.
No, please, Nicky.
I think it depends on the view of the Fed, right? So if gold is an inflation hedge, if the market believes the Fed is going to be behind the inflation curve, i.e. real rates are not going to rise too quickly, too fast, which will deter the appeal of precious metals. If that is the view, then yes, gold is a decent inflation hedge. But if the view is that the Fed can tackle inflation and will embark on a very aggressive hiking cycle, that's just going to drive the dollar higher and real rates higher. And I think what I call this over tightening risk in precious metals, and it's I think gold then just really battles because of higher real rates.
Well, gold, I think, is many things for many people. One reason why people demand gold is, of course, to have a safe haven asset. And the question, is gold an inflation hedge, is a very important one. And if you take, let's say, the last 2 decades, then you would see that the gold price in US dollar terms has increased on average by around about 8% per annum. And certainly you can say that has compensated the investor against the actual inflation rate. And I think this is something that will remain in place. Admittedly, in the last two and a half years, gold hasn't shown this close relation to the changes in consumer prices or asset prices. But I think this will be only temporary. Over the long term, I think there's reason to believe that gold still is an inflation hedge and is also a hedge against, let's say, counterparty risks in the financial system. So on average, I would say that those who have a long-term view, who invest with an investment horizon of 3 or 5 years, have a good opportunity right now to build up additional gold positions.
I think one way of looking at it, just really quick. Oh, I'm sorry. Go on, Mark.
No, go, Jim.
One way of looking at it, sort of tilting towards Nicky's view, is that gold tends not to react so much to the latest bit of inflation data as to the anticipated monetary response to that data. And if everybody's convinced that not just the Fed but other central banks are on the ball and are going to react quickly, then that very often explains why you get a higher inflation print and all of a sudden the gold drops. It only took me about 15 years to learn, by the way, after I started covering the gold market.
I think one thing that's worth noting on gold, if you look at gold versus inflation versus most other major commodities, either individual or you break out the groups, you look at sort of energy as a basket or base metals as a basket, gold has pretty much the lowest correlation of anything except actually some of the agricultural commodities to inflation. But exactly as the point is made, in some ways gold is still the best inflation hedge, or in certain circumstances, unless another commodity is the cause of the inflation, like you have an energy supply shock, gold is the only inflation hedge. Because if you do have a massive disorderly inflation spike, and to Nicky's point, the Fed is behind the curve and people think it's kind of unwilling or unable to rein that in, then absolutely gold is a brilliant hedge, as it was, of course, sort of 1970s, early 1980s. But if actually you have demand pull inflation and relatively strong and robust growth and a central bank policy response that is keeping check there on inflation and its impact on real rates, rather than seeing the inflationary spike drive real rates deeply negative, gold doesn't perform very well in that environment. And that's why actually gold's inflation correlation shouldn't be that good, but that doesn't mean it's not in extremis the best inflation hedge, in my view, amongst sort of any of the commodities on offer, if you want that as a general thing to have in your portfolio.
Right, you've got the gold-silver ratio at the moment slipping lower, last at about 87.5. What is this telling us at the moment?
The gold-silver ratio has rallied from 75 to 87 this whole year. So I think it's certainly increased, not come lower. But yeah. I look at it as it's sort of indicative of tapering and QT happening, right? I think of silver as, the better sort of easier financial conditions hedge versus gold. When the Fed was QEing from 2010 onwards, silver was sort of your high-flying metal and more sensitive to easier monetary policy. So the fact that the gold-silver ratio has been steadily increasing all year, I think it's just very indicative of tighter financial conditions, higher US dollar, and the Fed basically withdrawing its balance sheet.
Anyone else want to comment on that?
Sorry, struggling to unmute myself. I think, exactly to Nicky's point about financial conditions, but that if you think about how that sometimes flows through into the real economy, that silver is a kind of dual or hybrid industrial and precious metal. Although it's by no means perfect, but if you look at changes in the gold-silver ratio versus changes in global growth, if you look at that in global GDP estimate or on a monthly basis, like global PMI or global industrial production, they do move relatively well together in directional terms, such that silver outperforms when you have an accelerating or already quick pace of global growth, and underperforms when you have a decelerating one. So I think much of the time, the kind of level of the silver price is probably more set, not always, but more often set by its precious metals characteristics. But those relative changes to gold are then somewhat driven by its industrial base. And that differentiation is kind of quite consistent with what you see in terms of the gold-silver ratio versus the business cycle.
Thank you for that. I'm just mindful of time, so I've got a couple of questions, quick fire questions I want to put to the panel. Yes or no answers, or very succinct answers. I'm happy to go around the group. What will we see first this year? Gold below 1,700 or above 2,000? Nicky, should I start with you?
What do we see first, 1,700 or 2,000?
Yeah.
1,700.
Anyone else?
Second, Nicky on 1,700.
I think if you assume that both of those levels will be hit, which I'm not sure if that will be the case, it would be 1,700 first.
I would say it's more likely that we see the 2,000 rather than the 700.
1,700. Okay, so a couple of bears and a bullish outlook there. Will we see inflation below 3% in the US this year?
No.
Only if you have a really severe recession. Sorry, Jim.
I don't know. I beg your pardon. I defer to our crack HSBC economics team, which I don't think they're looking for that.
Right.
Well, I would say
to your point,
but they are looking for moderation.
Yeah.
Right.
Maybe one remark on the inflation outlook in the US. I think at the moment it's underappreciated that the money supply M2 is contracting in the US for the first time since 1959. And this is, according to our analysis, due to higher interest rates and QT. The money supply is really contracting. That's something we haven't seen in decades. Basically, we have never seen such a development. So it's a very restrictive impulse underway. And I think the chances of a recessionary outlook in the US increases. And having said that, there's a chance that inflation will come down much more severely than most people expect. So I would say, yes, there's a certain probability that we see 3% CPI inflation in the US in the course of this year.
Okay. To your point, then, will we see a recession in the US or Europe in 2023?
Well, there are various indications at the moment. Some are good, some are less good. Let me start with Europe. I think in Europe we see a contraction again in the money supply data, and according to recent experience with contracting monetary supply aggregates and contracting credit aggregates, the probability of a recession is clearly on the rise. And I would say the same is actually unfolding in the US. People keep looking at current CPI, and central banks set interest rates in view of current CPIs, but my sense is they overlook the information content provided, for instance, in the monetary data. And as I said earlier, I think there is a risk of overdoing it, of over-tightening. And I think James referred to that earlier, that once you get an over-tightening, then central banks can be very quick to reverse their policy stance. And I think this is certainly a scenario investors should keep in mind.
Anybody else want to wade into that one?
Well, I just skirting whether we'll have a recession or not, which I think we have to leave to our macro people. Just one point that touches on that is that the underlying industrial demand for particularly silver and platinum is going to be better than the overall industrial production figures or the global GDP would imply. So that even if we do get a slowdown, even if we do get a recession, I'm not saying we will. When you look at the key things like solar power and chemicals and other things for the platinum, for the environmental, I think they're going to outperform. So it's I think investors have to watch that they're not misled by the aggregate figures, because I think both those metals industrial demand side is going to outpace the aggregate numbers.
Thanks, Jim. Just checking if we have any more final questions. I think that's about it, I think. Look, I think we might leave it there today. Thank you very much for dialing in. A big thanks to our esteemed panelists. If we didn't get to you all submitted questions, we will try to get back to you directly. Hopefully the discussion today has been of some use and helped firm up your own opinion of the precious metal market and where prices may be heading to for the rest of this year. With that, I'll hand it back to Tamsin to wrap it up from here. So thank you very much.
Thank you, Cameron.
Thank you, Cameron. And thank you everyone for joining today's session. So before we wrap up, just very quickly, we just want to let you know about some of our upcoming events and training courses. So later this week, we have the LBMA annual party on the 2nd. And the 12th to the 15th of March, we've got our Assaying and Refining Conference, and tickets are available online for these. And then later on in May and June, we have our training courses, an introduction to Loco London, how to use Loco London, and an introduction to responsible sourcing. And then just some further dates for your diary. The 6th of July will be the LBMA AGM, and the 12th to the 15th of October will be our LBMA LPPM Global Precious Metals Conference. You can find more details of these training and events on our website, or you can email us at events@lbma.org.uk for more info. This webinar, along with all of our previous webinars, will be available on our website, lbma.org.uk/webinars. Now, if we didn't get to your question today, or you have any follow-up questions, please feel free to send these to ask@lbma.org.uk, and we will forward these on to the panelists. So thank you again for joining us, and have a lovely day. Goodbye.